Bond Valuation Screencast 2 with Diana Temsky at the University of Wisconsin, La Crosse. So let's look at how we value a bond. The value of a bond or any financial asset, read any security there, is equal to the present value of its expected future cash flows. This will apply to stocks as well, which is the next content area we'll be going to. I highly recommend that you memorize that definition in your mind. It should help you tremendously as we value securities. So the value of a bond, that's what we're looking at right now, but any financial asset, the value is equal to the present value of its expected future cash flows. So let's look at valuing a bond, and we'll start by doing annual valuation, and then we'll move to semi-annual, just for simplicity's sake, if you will. So what is the value of a 10-year, 10% annual coupon bond if R sub D equals 10%? What is R sub D? R sub D stands for yield to maturity. It's one way we can express yield to maturity. With bond valuation, we have two different interest rates that we're looking at. We have the coupon rate and we have the yield to maturity. So let's look at how we do this on our calculator. Expand here. So we've got a VA2 Plus calculator, and let's look at how we plug this in. So a couple of things first. Number one, double check your P/Y setting. Second, hit the interest button. Make sure it's set to 1. If it's not, if it says 12 or something, do 1. Enter. It just makes it a whole lot easier. And then let's clear out time value of money to make sure that is done. So when we value a bond, there's a number of different inputs we plug into our calculator. One thing that you do not see here in this problem is what the future value is. And in the previous screencast, I told you that that's one of the features of a bond, this thing called par, the face value, the amount to be paid at maturity. And we're going to assume, unless told otherwise, that it's always going to be 1,000 because bonds are sold in increments of $1,000. So 1,000 future value. You're solving for present value again, just a reminder. And we're doing annual payments right now to make it easier. So 10-year, that's going to be our N, 10, N. And then we have this coupon payment business. What do we do about that? Well, the coupon payment you learned in the previous screencast can be computed by taking the coupon rate as a percentage and multiplying it by par. So if you take 0.10 for the 10%, multiply that by 1,000, you find that the payment, the amount that the issuer is going to pay the investor, is going to be $100. And we'll leave that positive, okay? Kind of important to make sure you enter the right things as positive and negative into your calculator. We're doing things from the position of the investor right now. So this would be the positive amount for the investor, as would be the future value, okay? So that's $100. And then I ask you the value if R sub D equals 10%, if that yield to maturity is 10%, that 10% yield to maturity is our I in our calculator. So now you have everything you need to compute present value, and boom, you find that this bond would cost the investor $1,000. So you just found that it's going to cost the same amount that the investor is going to get when it matures, $1,000. That is correct, and I'll highlight those notes on a future slide here in a couple of minutes. But just a side note, any time the bond is sold with the coupon rate equaling the yield to maturity, it's going to sell for par. Okay, the last bullet on the slide there says, suppose the same company has 10-year bonds outstanding with that same required rate of return, which is another way to refer to yield to maturity or R sub D, 10%, but annual coupon rates of 13% or 7%. What is the present value then? So you can hit clear now, and you can enter those different coupon payments. Let's do the 13% first, okay? You can leave everything else in your calculator. The only thing that's changing is the payment. So a 13% annual coupon rate, if you take 0.13 times 1,000, that's a payment of $130. And we're going to go ahead and compute the present value, and you find that the bond sells for more, for $1,184 and about 34 cents. Is that puzzling? How come an investor is going to pay more than what they're going to get in 10 years? They're going to get $1,000 when the bond matures. They're paying more. How come? Because the yield is greater. They're paying for those coupon, the yield to maturity is the same. I shouldn't say the coupon rate is greater. They're essentially paying a premium for those $130 coupon payments that they're going to get every year. And when a bond sells for greater than $1,000, we call it a premium bond. The investor's paying a premium. They're paying more than $1,000. Okay, you can hit clear, and let's do that 7% coupon rate. A 7% coupon rate tells us that the coupon payment is going to be $70. Compute that present value, and you find that it's $815.66. It went down. It's discounted. Anytime a bond sells for less than $1,000, we call it a discount bond. Okay, now that you have some basics and how to compute a bond value, the price that is, a couple more notes for you before we do yield to maturity. This screen is just a graphical representation essentially of what we just computed. And one thing to make note of that we did not do, but that we could have, and if you want, you could on your own. When the bond is selling for a premium, meaning it's selling for, where's my cursor there? Selling for more than $1,000, the price declines over time. Bonds are traded. Investors can buy and sell them, of course. So over time, the investor buys it for $11.84. The price is going to drop. And if you were to find what the price on that bond would be, what the present value is, when there's only 5 years left to maturity, you would find that it would be lower than the $11.84. And that price will continue to drop until it gets to $1,000 in the future value when it matures. And the same thing is true for the discount bond. The price will go up over time until it reaches the $1,000 future value as well. So a couple of notes that kind of match the graph we just looked at. Bond values over time. At maturity, the value of any bond must equal its par value, meaning usually $1,000. If R sub D, now R sub D is another way to refer to our yield to maturity or required rate of return. If that remains constant, if R sub D or the yield to maturity remains constant, the value of a premium bond would decrease over time until it reached $1,000. And the value of a discount bond would increase over time until it reached $1,000. And finally, the value of a par bond stays at $1,000. And that's exactly what was illustrated on that previous slide for you. A couple of other notes that kind of illustrate and match the calculations we did. Some what I call bond rules of thumb that are useful to memorize with studying bonds. If the coupon rate is less than R sub D, or yield to maturity, the bond sells at a discount. If the coupon rate equals R sub D, or yield to maturity, the bond sells at its par value. If the bond rate is greater than R sub D, the bond sells at a premium. And finally, if R sub D, or yield to maturity, rises, prices will fall. There's an inverse relationship between yield to maturities and bond prices. There's an overall, you could think of this in relation to all securities because it works for stocks too, but as returns or as the rate of return goes up, the prices will fall, and vice versa is the case. As the rates of return go down, the price goes up. Why is that? Think of supply and demand. If the interest rate for something goes up, that means that risk is going up along with it. There's a direct correlation between risk and return. So if risk goes up and the rate goes up, in this case the yield to maturity, investors are willing to pay less, so prices fall. Conversely, if interest rates drop, that means there's less risk involved, the prices go up because investors are willing to pay more. All right, so now we're going to look at solving for yield to maturity. This R sub D we've talked about so far. What is yield to maturity? What is this thing we've been kind of alluding to so far? Yield to maturity is the rate of return earned on the bond held until maturity. We can call it the promised yield. We can call it the market rate. We can call it R sub D. We can call it the required rate of return. Lots of different ways to refer to it. Yield to maturity does assume, as we're looking at it in the classroom here with bond values, we assume that the bond is not going to default. So what is the yield to maturity on a 10-year 9% annual coupon, $1,000 par value bond selling for $887? So let's bring in the calculator. So there's our last calculation we did. Let's clear that out. And let's clear out time value of money. So what is yield to maturity? We're going to solve for our I/Y. That's our yield to maturity in the Ba2 Plus on a 10-year. And we're assuming annual coupon payments at this point. So 10 is our N. 9% annual coupon rate. That coupon rate we compute multiplied by 1,000 to find the payment. So 9% would be 0.09 times 1,000. You need to kind of see it like that. I didn't do this last time. So $90 would be our coupon payment. The $1,000 par value, whoops, one too many zeros, is our future value. And the bond is selling for $887. And let's make that the negative. That's our cash outflow as an investor. That's the price the investor is paying, so that's our present value. Finally, we compute the I. And you should find that the yield to maturity for this particular bond is 10.91%. Well, let me show you something in the calculator that I had not done before when we looked at time value of money. Let's plug in all these inputs for a second. Forgetting the signs, let's leave them all positive. So exact same inputs we just plugged in. That's what I'm doing right now. And I'm not going to leave anything negative. I'm not going to plug in a negative present value. I'm not going to assume any negative cash outflow. And let's compute the I and see what happens. Error 5. I did not do this for you, time value of money, but remember that I should with bonds. The calculator recognizes, this calculator at least recognizes things in terms of inflows and outflows. So you have to tell the Ba2 Plus what the cash outflow is because something has to be. Otherwise you get this error 5. So how do we fix that? We just make sure we enter the correct item. In this case, it's the price that the investor pays for the bond. Make sure you enter that as the negative. And voila,